What's up, everybody? No one wants to catch a falling knife. This is what chief economist from KPMG, Diane Swonk, told Fortune when talking about the process of home prices falling nationally. She explains that there is a self-fulfilling momentum to home prices falling once they start. She then goes on to say that she believes we will easily see double-digit declines and that 15% next year is very conservative. So today, we're going to take a look at an article by Lance Lambert in Fortune titled KPMG, the pandemic housing bubble is bursting, to see what else Swonk is saying, as well as an article by Realtor.com to see what to expect in the housing market for the rest of 2022 and going into 2023. So let's just dive right in. It was a pandemic-induced housing bubble, which was stoked by work-from-home migration trends. High-wage workers going to lower second-tier middle markets for more space. To Diane Swonk, the chief economist for KPMG. We went to an extreme on work from home, which spurred housing demand, but it is pretty much abruptly ended. It is part of the reason I think you're seeing housing prices fall as well. The local incomes just don't support a lot of these home values. Well, we've already seen home price growth roll over on a national basis. Between June and August, the Case-Shiller National Home Index showed a 1.3% drop in U.S. home prices. That marks the first decline since 2012. So here are the four big takeaways from Fortune's chat with Swonk. The first one is that spiked mortgage rates popped the bubble. As we all know, the Fed Reserve is fighting inflation by raising rates. And although the Federal Reserve does not set mortgage rates, its actions indirectly affect them. As the Fed raises rates, so do the banks. And once the Fed gets into rate hiking mode, it's going to spell trouble for rate-sensitive sectors like the U.S. housing market. And when those rate hikes turn aggressive because they really want to up their fight on inflation, it will get more and more intense. And this is what's happening now. Due to the Fed's monetary tightening, the average 30-year fixed mortgage rate went from 2.98% to 7.1% over the past year. And that mortgage rate shock matters for two reasons. First, historically low mortgage rates, which sparked and stimulated the housing boom during the pandemic, are gone. And second, the spike means that many would-be buyers have either been priced out of the market or have lost their mortgage altogether. The second takeaway is that home prices are falling, but it isn't the 2008 story. Lambert writes that if U.S. home prices do fall 15%, it would mark the second biggest U.S. home price correction in post-World War II era. Only the 27% correction between 2006 and 2012 would have it beat. That said, the Federal Reserve says this is not a repeat of the financial crisis of 2008. From a financial stability standpoint, we didn't see in this cycle the kinds of poor underwriting credit that we saw before the great financial crisis. Housing credit was much more carefully managed by the lenders. It is a very different situation in 2022. It doesn't appear to present financial stability issues, Fed Chair Jerome Powell told reporters earlier this month. And Swonk agrees with Powell. This is not a subprime crisis. There, the Fed is correct about that. However, while improved lending standards and tight housing inventory may prevent a 2008 repeat, they aren't enough to prevent a housing correction. At least that's how Swonk sees it. The interesting thing to me is how quickly some of these markets are correcting with still very tight inventories, Swonk says. The third takeaway is not every market is going to crash. According to Fortune, the textbook definition of a housing bubble requires three things. First, you see exuberant demand, boosted by speculation, rush into the housing market. Second, spiked home prices soar well above what local incomes can support and reach overvaluation levels. And third, the housing bubble pops and home prices fall. Well, in the past 2 years, due to historically low interest rates and the fact that many people could work from home, demand became manic, especially from investors, flippers, and iBuyers. And as for the second criteria, Lambert writes that every quarter, Moody's Analytics calculates an overvalued and an undervalued assessment of over 400 markets. The firm aims to find out whether the fundamentals, including local income levels, could support local home prices. In Moody's Analytics calculation calculations for an overvalued market. They concluded the typical market was overvalued by 23% in the second quarter of 2022. That's up from 3% from the second quarter in 2019 and above the 14% in the second quarter of 2006. And as for that third criteria, well, Swonk says that the bust has started, but it will vary from market to market. She takes Phoenix and Chicago as examples. In 2006, Chicago and Phoenix were both overvalued by 32% and 48% respectively. However, this time around, Phoenix, which is now overvalued by 54%, saw a rush of speculators and out-of-town buyers, while Chicago, which is now overvalued by 3%, remained relatively tame. The markets that soared during the pandemic boom will also be hit the hardest during the correction. Moody's Analytics is currently forecasting an 18.7% peak-to-trough drop in home prices in bubbly Phoenix. In Chicago, the analytics firm expects home prices to fall just 3.6%. And lastly, falling home prices help the Fed. I mean, come on. Federal Chair Jerome Powell specifically said that we are in for very difficult times during this home price correction. He called it a reset. What he's hoping for is that home prices come down, demand calms down, and inflation retracts. Let's face it, where's one of the biggest pushes on inflation right now? It's in shelter costs, and it's where they, the Fed, have the most power, Swonk says. And so yeah, it was a stunning rise in home prices, an unsustainable rise. Some kind of correction is needed. The problem is, you don't get to choose how big that correction is. And I agree with her. The housing market was unsustainable. It was way out of control, and we definitely need a correction. What worries me is just it's so manipulated by the federal government that we just don't really know what's going to happen in the future. But let's pivot to the Realtor.com article. This article, ironically, is titled, "No One Wants to Catch a Falling Knife: What to Expect in the Housing Market for the Rest of 2022." In this article, Claire Topasso writes that the housing market appears to be in a standoff as just about everybody suddenly feels stuck. I mean, home prices are beginning to fall, especially in some of those hot, overvalued, bubbly markets, but still not enough to make up for the higher interest rates. This is what I've been talking about in my recent videos. Buyers still can't afford to buy with these high interest rates because prices just haven't come down enough to make housing affordable. And one of the reasons that they haven't come down is because there's simply still not enough inventory. Because sellers don't want to trade in their low interest rates to go buy another house with a higher one. But hey, maybe when Redfin offloads all of its iBuyer properties, this will create more inventory. For all those buyers out there, I certainly hope so. So what's next as 2022 comes to an end? Many experts believe that home prices will fall nationally anywhere from 10 to 20%, like Zandy of Moody's Analytics and Swonk from KPMG. Some markets may even have deeper price declines if they are very overvalued, like Boise, Phoenix, and Austin. However, it is important to put any price declines into perspective. Topasso writes that nationally, home list prices rose 40.6% in just over 2 years' time. From March 2020, when the pandemic lockdown began, to the peak of the market just this past June, according to Realtor.com data. So a 10%, 15%, even a 20% drop over a 2-year span isn't as significant as it might seem at first. A really important thing to remember is that housing is cyclical, says Wolf of Zonda. We came from a massive run-up in prices, sales, demand in the housing market, and now it's contracting. This is not new. I think we're just gonna have to see what the Fed Reserve does in the future, how the iBuyer program failures affect inventory, and whether builders can increase confidence by offering buyers incentives or other ways to get them back in the market. Right now, as we enter the holiday season, I don't really see much changing at the end of this year, but at the beginning of next year, things could change. But I guess we're just gonna have to wait and see. But what is happening where you guys live? Are you still seeing multiple offers? Are you seeing a lot more inventory? Are you seeing a lot of home price reductions? Definitely comment below, tell us where you live, and tell us what you see. This is the best indication of what is happening in the housing market. Where I am in the DC area, prices prices just haven't come down that much. In fact, good houses are still selling with multiple offers. And when I say good houses, I mean houses that are in great condition, that show really well, and that are priced appropriately. It's the greedy sellers that are pricing their houses at the comps that sold at the peak of the housing boom that are sitting and having to reduce their price and not getting the value that they should if they price them appropriately. And for these houses, I do think there are possible deals to be made right now if you can withstand the current interest rate. I hope you got some value out of today's video. I really try to bring you the most up-to-date information on the housing market so you can make the best decisions for you and your family. As we enter this holiday season, I do wish you all a very, very, very happy holiday season, and I do want to express my sincere gratitude and your support for my channel and watching these videos. And speaking of that, if you want to show some support, definitely smash that like button, comment below, and consider subscribing. It just motivates us to make more videos. And if you do want to see other housing market videos, because they do come from all different sources, definitely check out these two. Thanks for watching. I do appreciate it. Bye!